Hello and welcome to this Forex Preview at xm.com. I'm Maria Bashardis and joining me is investment analyst Marios Hadjikyriacos. We'll be discussing upcoming U.S. employment data and the outlook for the dollar. So Marios, although the U.S. economy has been negatively affected by the ongoing trade war, which has hit the manufacturing sector hard, it's still in a better position than any other major economy at the moment. What are we expecting to get from the upcoming employment data, and what might the market reaction be?
I think you nailed it right on the head, Maria. The US economy, it has lost some momentum this year. So, for example, growth in the fourth quarter is likely to be much slower than earlier in the year. Investment has taken a hit from the trade war, and the manufacturing sector has almost come to its knees. But the overall economy is still not in a bad shape. So, for example, consumption is very healthy. The consumption is also being supported by rising real wages, by a healthy jobs market, consumer confidence is high, and even the housing market has recovered a little following the recent Fed rate cuts. Now, the point here is that, yes, the US economy has lost steam, but it's still much, much healthier than its main counterparts, those being Europe and Japan. Now, as far as the upcoming data are concerned, I think that the risks surrounding the dollar from this data, from this employment report, are asymmetric and tilted to the downside. So that means that if we get a positive surprise in this data, then the upside reaction in the dollar may be relatively modest, but if we get a negative surprise, that could see a much sharper downside reaction in the dollar. Now, the logic is this. The markets are pricing in only a 20% chance for a Fed rate cut by March. That means that the market doesn't expect the Fed to act anytime soon, so in the first quarter of the year, of the next year at least. So if we get some strong data, some stronger than expected data this week, that would confirm the market's view. The Fed is not going to act over the coming months. And that could cause the dollar to spike higher, but only modestly, in my opinion. It wouldn't be any surprise. Now, if we get disappointing data, though, that would suddenly tell the market, oh, the Fed might indeed cut by March. So we might see that 20% probability rise quite significantly, and that could trigger a much more violent, let's say, downside spike in the dollar.
I see. So given all this, what's the broader outlook for the dollar heading into the new year?
Well, even if we see a negative reaction this week, I would say that the overall outlook is still positive. And the real argument is, where else do you hide outside of the US economy? So the reserve currencies, let's say, the dollar, the euro, and the yen, out of those three, only the US economy is still in a good spot. Growth in Europe, for example, is almost stagnant, and who knows, the euro area might even be struggling with a recession next year. Japan, likewise, the growth is slowing, inflation is almost back at zero, and there's very little policy room for the Japanese government or the Bank of Japan to do very much to change that. So I think that the outlook for the dollar is still positive for a lack of viable alternatives, and for this to really change, I think we would need to see the national governments of the euro area announce a large fiscal stimulus package. But that is not very likely to happen, at least over the coming months. So I would say that the broader risks surrounding euro-dollar heading into the new year are tilted to the downside.
Marios, thanks so much for joining me, and thanks for watching at xm.com.